Welcome to Origins, the podcast where we dive into the LP and VC ecosystem and learn how the people behind the capital make decisions, just like you, Beezer.
Thank you. And I'm Beezer Clarkson, a partner at Sapphire Partners.
I'm Nick Charles, partner at Notation.
And this week, we're speaking with Frank Rotman, who is a founding partner and CIO at the firm QED Investors and an incredibly thoughtful and deliberate person.
I love that title, by the way, CIO. That's rare in venture.
Mm-hmm.
Frank, he's an OG operator and fintech investor, very early helped build Capital One, the co-founder at QED. He's also super active on Twitter. So yeah, what's our plan? What are we going to cover?
Our plan is, he is someone who thinks long and hard about venture and how do you be successful in this business as both an individual, like as a human, as an investor, and then as well as a firm. And he's posted a great deal about all these topics. So we're going to hit him up to talk about how he became an investor. He's posted about the three-body problem as it relates to the VC ecosystem. We're going to chit-chat about that. We're going to let him have his 2 cents on this whole debate on VC associates and the role they play and the role they play at QED and how he thinks about training. And also, for those of you who saw his posts about the mistakes made during venture, he's going to talk a bit about that too, I think.
Yeah. Are you an investor in fintech specialists?
For reasons I think Frank's going to talk to us about, fintech is an area where we do think expertise is incredibly powerful. So we have looked to build out our portfolio with folks either within firms or maybe dedicated as a firm to fintech and understanding it.
Which is maybe rare for you guys, right? Like you're not too active in sort of specialist categories.
Generally not. Fintech is a category. There's some others that we feel the same way about. But fintech is one of those where, and I'm hoping Frank can unpack this for us a bit, where I think of it more of as an expertise and an understanding can be very helpful for reasons, again, I'm going to let him chat about since he's so strong in this. But we have considered this as one of the few areas.
I think this will be a fantastic conversation, and let's go do it.
Frank, thank you so much for joining Nick and I in Origins. It's really wonderful to have you here today with us.
Happy to be here.
I don't know if you remember, Frank, but I went back to figure out when we first connected, and it was back in 2021. And I have to give thanks to Twitter and thanks to you because I was this big fan follower of your posts and finally got up the courage to reach out and ask if we could repost them on OpenLP. And you were very gracious and said yes. And it struck me then, and it continues to strike me, how thoughtful you are in your posts and the insights and the education you offer into how venture has been done well and when we're not doing it so well, how it develops as an investor, which I don't think the world talks about enough, and what it takes to be a great one. And so Nick and I are really excited to have you here to share your learnings with our listeners. Hopefully they start following you on Twitter, as they all should. And if it's okay, I'm going to give a little bit more bragging about your background. Is that cool?
Oh, appreciate that. And thanks for the kind words.
Of course, of course. So for those that don't know you, and they all should, you've had an incredibly formidable career. You are now the CIO of QED Investors, not to mention a founding partner there. You are a 6-time Midas List Hall of Famer. And before all that, you helped create a company called Capital One, which if all of that wasn't extraordinary enough, you started life at NASA on your resume. And you spent 2 years there as a research assistant in their jet propulsion laboratory. So I know we're not technically in a great recession. Thank goodness one of those was enough. But for folks today who are still trying to launch businesses in a tough venture market, could you talk to us about how you and Nigel came to launch QED and maybe lessons learned from doing it during one of the down markets?
Nigel and I, our first act, if you want to think about it that way, was, building Capital One together. He was the co-founder of Capital One and I was his right-hand man, and did a variety of things there, from being the first chief credit officer of the company before there was even a title for that. Built some of the businesses at Capital One that were important and formative in scaling. So if you name a business unit at Capital One, I probably touched it, built it, fixed it, or if it's not there, maybe even shut it down at some point. So there are a lot of things that I did there, a lot of things Nigel did. He was the president and the COO and helped scale the company to a kind of a global entity with tens of thousands of people. So he left in 2004. I left in 2005. I actually left to build a student lending company, and Nigel left to kind of explore the world and be a bit more promiscuous and see what else was out there. But we joined back up in mid 2007 to basically say, look, we should be working together. We love working together. We have a pretty unique set of skills, having built a number of financial services, fintech businesses. There wasn't actually a name for, fintech at the time. And we were exploring what we wanted to do together. I mean, that was really the origin of QED, was trying to figure out what we wanted to do. There was a third individual, Caribou Honig, who also came from Capital One. And the three of us really put our heads together and said, with our unique skills, like, where could we be valuable and where would we have fun? And what we found very quickly is that we were operators masquerading as investors. And it was a pretty unique skill set to have in a market where it requires very technical skills to build some of these businesses. So it ends up that what we were offering was valuable, and the VCs did want our advice on these companies, and there was room on cap tables and around the board for us to help. And, 5 or 6 years later, we decided that the opportunity was bigger than our own capital. We had found some really interesting companies, and we felt like we actually understood at least the basics of what it was to be an investor. We were much better at being operators than investors, but we figured it out. And we crossed the divide, right? We crossed the Rubicon and started taking other people's money about 6 or 7 years in. Now we're, billions of dollars under management. Our most recent fund is $1 billion-ish, fund split into an early stage and a growth fund. And we've invested in 225-ish companies over the past 16 years.
How would you define the basics, learning the basics? And maybe what were some of the big learnings from the early days? I mean, you guys invested in Credit Karma very early in 2009. So that was a big win, obviously. So would love to touch on that. But just curious, when you look back at the early days and then sort of like 3, 4, 5 years in, what were the main takeaways and basics that you would describe?
Yeah, so as an outsider coming into an industry, where there are a lot of very big personalities and big outcomes, there are a couple things that you just don't realize. The first thing is these big personalities and these big outcomes, it's actually a pretty tiny asset class, or it was at the time that, we were investing. To put it in perspective, in fintech at the time, in 2008, about $1 billion globally was invested in fintech. And at peak, that number was 140 billion.
Wow.
So those aren't the same ecosystem. So when we got involved, it was a very, very small ecosystem. Again, pretty unique time because global financial crisis, things had kind of tamped down and there wasn't a lot of activity. But, when you have a unique set of skills and a lot of the big personalities that are investing in the space are generalists, you realize that in these highly technical areas, the expertise is not shared by these supposed experts that are, big personalities that are in charge of all of the capital and funding the companies. They don't really know a lot about lending. They don't really know a lot about payments. They don't know a lot about banking. So you have these well-known VCs with, a seasoned track record, and they're looking at businesses that they don't actually understand. And, the ability for them to come up to speed and understand it's almost impossible. So one of the big learnings is that, we were being forwarded a lot of deal flow, and we were, looking at term sheets that were being issued by, again, very seasoned, very good investors. And when you would talk to them about the company, you'd scratch your head and say, wait a minute, what do I have wrong here? Because I don't think they understand what they're actually investing in. I don't think they understand where there's leverage. And, in the early years, it's part of what made us valuable is that, we could educate the VC as well as educate the founder, or at least help them avoid, obvious potholes and mistakes that they might end up make in these highly regulated spaces where they might or might not know exactly how they work. It made us valuable as board members, but it also meant that one of the biggest mistakes that we made early on, we had to correct for, where being tucked into other people's deals where you relied on their diligence, really made no sense when you were the expert.
Right.
So we would get these deals and the term sheet had already been issued, and a VC might say, do you want to join? We'd love to have you around the board. We've done all the diligence. And that trust, like, really had to go back to first principles and say, look, I know that you like the company, but let us start from scratch and figure out if we like the company. Right? It's not a given that just because you're a great investor, that you're a great fintech investor. So some of the biggest mistakes we made were just following along on term sheets. And I think there are some new managers that I've seen their diligence, and their diligence is Sequoia's investing, Excel's investing, right? Like
QED's investing.
Yeah. And again, sometimes we are signal, for other people.
Yeah.
So I do get the two-sided nature of this. But, we really had to say, look, I mean, even great investors might not share our thesis. They might not see a company the same way we do. And even the best investors, they're only right about 25% of the time, right? Like, no matter how good they are, there's only 25% of their portfolio where they're right, and probably 10% where they're really right.
Mm-hmm.
Right.
Yep.
And that was something that we had no insight into as outsiders coming into the industry. We just thought that these investors are great investors and everything they invest in is like really good. So if they're issuing a term sheet, they've done the work. We really had to start from scratch. And that was probably a big learning, and something that I share with a lot of tuck-in smaller fund, like newer managers that are just trying to get allocation in deals, and their underwrite is the VC that's underwriting the deal. I think that's a colossal mistake.
You wrote a post 2 years ago called The Three-Body Problem. Now, obviously a Netflix show that lots of people have seen. I'm curious, you sort of broke up the universe into 4 different types of firms that may be viable. I believe it was scale, non-consensus alpha, late-stage generalist, and solo capitalist as sort of the 4 areas to potentially win and succeed in venture. Curious if you still maybe update 2 years later. Like, do you still believe that's the case? And sort of follow-up questions. Curious how you think QED fits into those sort of quadrants. We'll link to the show notes so folks have some context around the post.
Yeah, the white paper was written 2 years ago. And, the premise behind it was really a famous physics problem called the three-body problem. And the science fiction book was written about that same, physics problem. In fact, great science fiction series. If anyone hasn't read it, they should.
Yes.
But that's not what I wrote my paper about. It was really describing that the VC ecosystem had to change, or a lot of people were going to be in a lot of pain, right? And going to have to work so hard in order to maintain a stable position in the market. And, my projection at the time was that a good number of the VCs were actually going to either evolve or die. And a lot of that is coming true. I mean, Beezer, you see this all the time. Like, how many Fund 2s are not able to raise Fund 3? How many Fund 1s are struggling now to raise Fund 2? And how many of the bigger funds are struggling to raise the amount of capital that they were really looking to raise? Like, this is becoming real. You're starting to see a migration from VCs back into actually operator roles, right? Where there's a migration out of being partners and principals and associates in funds and becoming operators again. You're seeing even some established funds have some infighting and shutting down, right? So I think this is actually happening. And I did a poll, I forget when it was, maybe 4 or 5 months ago, just to see what the industry thought. And it was very clear that the answer was that it was going to shrink by 25% or more in terms of headcount.
The number of funds or the number overall?
The headcount within the VC ecosystem in the funds.
Gotcha.
Right, which is one way of thinking about it. Because there could be a concentration of dollars in the bigger funds, but the funds that were successful would probably continue to be successful. But the question is, like, was there room for all of the funds that had kind of had the Cambrian explosion over, the past few years? And the purpose of the three-body problem was to say, look, in order to be in a stable point, within the VC ecosystem, as a partner within a VC fund, as a GP of a VC, you really have 2 very large constituencies. You have the LP ecosystem, and there are thousands and thousands of LPs that are out there, and what they're looking for are products that are manufactured by the GPs of these VCs. And they're really buying that product. So they're on a shopping expedition in order to figure out like how they can assemble the products in a way that, meets the needs of their capital. The other very large ecosystem is the ecosystem of founders, right? So all of the new startups that are out there. And in fact, the easier that it is to get from 0 to 1, the bigger the base of the pyramid. And we're seeing like an explosion in the base of the pyramid because it's getting easier and easier to at least get something off the ground, right? So you have this giant matching problem as a VC because you're sitting in the middle, where in order to be in a stable point, you have to have a product that works for the LPs and you have to have a product that actually works for the startups. And it has to be basically the same product. So it's hard if you look at these two ecosystems to find a stable point where you say, wow, I have a reason for existence in this ecosystem, right? I am ultimately a connector between the money that's given to us by the LPs and the ability to put it to work, and then the combination of money and then experience and advice and other things that come with the VC for the startup founders. And the purpose of the paper was to define 4 stable points that say, look, if you really want to be able to define a product that works for LPs and works for startup founders, here are 4 areas or 4 ways of defining yourself that actually make sense. And the problem is, if you actually look at most VCs, they don't fall into those buckets cleanly, right? And it doesn't mean that they won't succeed. It doesn't mean that they won't exist in the future. It just means they have to work harder, right? They have to work harder to explain to LPs like why they should exist. And in fact, you probably encounter this all the time. I mean, how many VCs come to you with a pitch where you could take the name of the person out and put the name of another person in, or take the fund out and put another fund in? And, like, what are you actually buying at that point? Like, where does that fit in your capital allocation when there isn't something where you say, wow, this has a purpose in the marketplace in a world of positive selection? Like, they are going to be at the top of that, list of choices of the top tier founders in order to produce the best returns. A lot of VCs, unfortunately, if you don't fall in one of those buckets, you're in the exhaust of a firm that is, right? Like, do you want to be what's left over after Sequoia has picked the bones of everything coming through their funnel?
Oh, you mean the adverse selection bucket?
The exhaust.
Yeah.
Right. So not looking at the quality stuff, you're looking at the exhaust. So, I mean, do you want to be in the exhaust of a top tier firm where they've already said no? So that's when you actually get to talk to the founder for the first time, or the founder will only say yes to you if someone in their first pick list says no. So a lot of the VC funds, unfortunately, fall into this bucket where they have to work incredibly hard because, if Sequoia comes to the table and issues a term sheet, like, they're going to win against you. And if you know that top tier firms are going to win against you, like, you're not in a very stable point. Like, you're not going to be producing top tier returns unless you can just kick and scream and work extraordinarily hard to get a founder to say yes to you. And they probably shouldn't, right? Like, the personal connection might be there, or the specifics that you might be able to help that individual business might be there. But is it repeatable? Right? Being in the exhaust of, a top tier firm, like, is that going to produce repeatable results? And again, that's why one of the stable points that I outline in the paper is non-consensus alpha, which is saying, go do the things that other people don't want to do. Like, become an expert in finding the things that aren't popular, right? The themes that people don't have a consensus view on. Like, if you're a second tier or third tier firm and you're chasing all the deals that everyone says, yep, that business should exist, and this is the team, and they're 2-time founders, like, you're not going to win that deal. And if you do, there's probably a problem with it. Or you're overpaying, right? Which then erodes returns.
There's a lot of kind of newer venture managers that are sort of, I mean, I include myself in that camp, that are sort of figuring out the path forward. Where's the most natural place for someone to start? I mean, it sounds like non-consensus alpha, like, do the things that other folks aren't going to do.
Yeah. So a couple questions there to unpack. Starting with QED, we have enough capital that we are an at-scale player. We have the ability to follow on multiple rounds of capital. We have the ability, as companies are proving that they have the right to exist in a market, to have the capital to be there with them. So we have the privilege of breaking what I think is a broken model within VC, which is a stage-based funded model where every single stage is funded by a different player. Like, I think that's actually a broken model, right? If you think about it, I totally understand why there's a first check writer into a company, because the base of the pyramid is so large that you need lots of people looking at deals that you don't really know much about it. It's more a narrative-based idea, and potentially a founder who's never actually built anything before. So a lot of what the base of the pyramid is about having enough faith in what you've heard that you're willing to pay to get a writing sample put out into the world.
Mm-hmm.
Like, that's all it really is. You're funding a check. You're saying, look, here's an author who's never written a book before, and they're writing a story that's never been written before, but it sounds interesting. Like, they wrote me a paragraph about what the story is going to be, and I'll pay to get an actual chapter written in the book and just see if it's interesting. And if it is interesting, what they do is they shout from the rooftops and say, I've discovered a great author and they're writing a great book. Like, at the end of this chapter, you're going to want to read more. So that's where a lot of the Series A, investors come in, where they say, wow, you've actually built something. There's some proof the market wants it. Like, you can actually do diligence on the team. You can see how fast they ship code. Like, there's a lot of things you can do with that writing sample. And then you end up funding the next chapter. The problem in the venture industry today is it's turned into alphabet soup, right? You have a seed, then you have a seed extension. Then you have an angel, then you have a pre-seed, then you have a seed, then you have a seed plus, then you have the A, then you have an A extension, then a B, and then a C, and then a D, and an E. It's alphabet soup. And every single round, what happens is someone funds it. They write the next chapter in the book, and then they shout from the rooftops to go find someone else to fund the next chapter, right? And it's a broken model, because what you're doing is you're giving advice to the founder about what the next person might want, not what you want. But the base of the pyramid for non-consensus alpha, for the first check writer, like if I were just starting, like, it's where I would differentiate myself, trying to find the founders and find the ideas that actually aren't popular and be able to get first checks into these companies and say, like, they're writing a writing sample. They wrote a writing sample that is really good. I'm not very good at just being a talent scout, right? That's not my personal skill set, because I want to help actually build the business. And I think some investors, they collapse to being talent scouts instead of actually doing work on the space that the founder is in, the business model they're chasing, and there's just so many times I hear from early stage investors, like, you shouldn't even underwrite the business at all. You're underwriting the founder, spend all the time with the founder. And I don't know, it's not how I would approach, being an early stage check writer. I think that's a piece of the equation, but whether people want to believe it or not, I disagree with so many of the consensus view of how this works. I believe that even great founders can fail if the market is not ready for the product that they're trying to create, right? And even great founders sometimes see a market slightly wrong. And even great founders might be putting a product in the market that, even if the people should be buying it or want it, sometimes they don't. As a CEO, I'm an asset allocator. I'm allocating money to one of three things. I'm either building product, I'm testing product, or I'm scaling product and capturing economic rent. Right? I have to know where I'm putting money and people in those three buckets. I have to know what stage the company is. I have to know what my learning agenda is. I have to know what my scaling agenda is. And I can have conversations with founders about all of those things. And I can get to know them through that and know the space through that. So again, I know we're kind of going all around this, circling it a bit, but if I were a new manager, I would focus on early stage. I would focus on non-consensus deals, either by geography or by topic, or by nature of founder, or something that the top tier firms might not be paying attention to. And I would spend a lot of time not just being a talent scout, but, really honing the profession and digging in and trying to understand, like, how they're going to go about building the business as a way of getting into the head of the founder.
Can I switch the topic a little bit? You and I have talked about this separately, and I've recently, and I'm sure you've seen this too, a very lively debate comes up every now and then, and it's back up about the role associates play at firms. And I want to use that as a sort of backdrop to the conversation you and I have had and you've had publicly, which is what does it take to be a great investor? And can you train that using the associate as the starting point? And I don't want to overly complicate this question, but part of what I'm also hearing when you're talking about being a scale investor is not only can you train an investor, but can you train someone to invest at different stages? Because it's not easy what you're talking about. So I'd be curious to unpack all that and hear your experience and what your wisdoms are for folks who are associates who feel unheard or maybe shouldn't be heard or whatever it is that you think it goes as.
So for the audience, there is a lexicon within the VC ecosystem in terms of career path. And some firms have all of the job titles and roles, and some firms don't, right? So it depends on the philosophy of the firm, the size of the firm, like what they're trying to accomplish. But there's associates, which are basically entry-level individuals. There are principals, which are, the next tier up. And then there are partners, right? Which tend to be the check writers within firms, and also tend to sit on boards if you are an active investor and sitting on boards. Like it's the partners that are sitting on boards and being the fiduciary of the money and being the consigliere to the founders, right? So there are these three stages within some firms. And you have a philosophy within some VC firms that the profession is so hard and what the founders are trying to do is so difficult that it's actually a very senior profession and it's not meant for junior people. And that's not casting stones against talented people who are early in their careers. But like if you're a talented founder building something very difficult and part of the value proposition isn't just money, it's advice and network. Like what role does someone with very little experience and very little network actually provide? Like it's a legitimate question that I think needs to be asked and answered. So if you're an associate, like you have to start asking yourself, what is your superpower? Like, why would a talented founder actually listen to me? If I were in a boardroom with the other investors, given their experience, given their backgrounds, why would they listen to me? And if the answer is they probably shouldn't, then you're probably not going to be a very good associate, and maybe the firm shouldn't have associates. Right. So I personally believe that the job is it is a very easy job to do poorly and a very difficult job to do well. And I think if you try to turn it into a factory, it's a way of justifying to yourself that it's a volume game. And if, you just see everything that's out there, which I do believe seeing a lot matters a lot. You can only do the deals you see. You can only connect the dots if you're seeing a lot of what's happening in an ecosystem. So like there is a certain level of just effort you need to put in order to just have the volume of conversations you need to build context, right? But some firms justify that as they actually put metrics on the board that say every associate is going to talk to 10 new companies every single week, and we're going to look at your pipeline. I don't think it's that type of profession if it's done well. Like I really don't. So you've got to ask yourself, like, what role do associates play? They can be very helpful in research. They can be very helpful in back office and really tracking a lot of things as data is coming in from the companies and looking at things. But are they really going to be the advisor of choice? I mean, there are some individuals where the answer is yes. Like they can ask and answer that question and say, look at what I've done. Look at the skills that I have. I always think of Liam Neeson. I have a very particular set of skills. But if you have that particular set of skills that a founder wants, then go hunt in those areas, like where you are the preferred person for them to talk to. But this volume game, the hard thing is if you took 100 companies and you put it in front of like a really talented top tier investor, they might have a different rank ordering of those 100 businesses than someone who doesn't have the experience to ask the right questions of the founder.
Do you think that's trainable? You and I have talked about this. Like, could you train someone to figure out which are the right questions?
I've talked to the Gen Z VC crew a number of times. I've talked to a lot of very early stage investors in their careers. And a lot of times my advice to them is, can you be honest with yourself and say, you would take your money if you were a talented founder? And a lot of times when the answer is no, it's time to go do something else and get some experience so that the answer can be yes. And there are a lot of ways of doing that. So there are some very talented investors who have never been operators. But what they've done is they've become extraordinary students of something. And they are extraordinary minds. And if you put the two of them together, like if you are just a brilliant, in-depth thinker and you take something and focus yourself on it and learn it, and you talk to all of the companies in the space and you become an expert on a thing, like there are people who are going to want to talk to you. And there are people who are going to want to take your advice. I mean, Matt Harris is a good example of someone who built his career on this. He got involved in payments when payments wasn't popular. He was a consultant before that, with Bain. And he just decided he was going to pick something that no one was interested in, become an expert in it. And he's friggin' brilliant. Like, I don't know if you spent time with Matt Harris. Like, he's
brilliant.
He's brilliant. And he is now an expert in payments, among other things. Like, there are a lot of things that he's now an expert in. But he built the early part of his career on doing something that no one else. It was a very technical thing that he just dedicated himself to and built all of the connections within an ecosystem. And like, of course you wanted to take his money. You would talk to him once and you'd know you wanted to take his money. So if I were an associate, I would say, look, if this is a career that I want, it's a career. It's not a tomorrow thing. So, break the world into 3 10-year increments, right? A 30-year career, and think about the first 10 years as building some of the skills and experiences that you need so that you can be valuable.
Yeah.
So at QED, like, we don't have any associates. We have principals and we have partners. And our typical principal, has 12 years of experience. Like, they're not junior people. And almost all of them come from being practitioners. Like, these are people with deep experiences in fintech so that they have perspective on what it takes to actually build things. And because of that, a lot of the founders are so happy to talk to our principals because they're coming with deep operating experiences where they could actually be helpful at solving problems and giving them advice, right? So there's a certain level where you cross that line and you become helpful. And you're not just ticking boxes and saying, I took the call, I asked 10 basic questions. I'm now saying this is in the 20% that we want to lean in or lean out. And then the founder has to do it all over again, when they talk to someone else at the firm. Mm-hmm. And again, I know this is an unpopular opinion for some of the firms that are structured that way. But, I find first calls actually incredibly difficult and calls that you need to prepare for. I will not take a half hour first call. First calls are so important. They're at least an hour. And it's because for me to actually get to the bottom of whether I'm going to lean in or lean out, and for me to actually figure out if this is in the top 20% that I'll take seriously or top 10% that I'll take seriously, like, there's work. It's not, let me ask 10 questions and hear about your background and say you are articulate and, the idea sounds interesting. Like, I want to really get into the depth, and that requires me preparing in advance and then being thoughtful in my first conversation with the founder. And by the way, this is not patting myself on the back, but I spent a lot of time with our team working on this. We win deals in the first call before we even issue a term sheet. Like, by the end of the first call, a lot of times we have founders who are saying, wow, what is it going to take to get you through diligence? Because, like, you actually understand our business. Like, you're the first person that we're talking to that kind of gets it. So there's an art and a science to this. The trainable part actually comes with cycles and experience. It's unfortunate, like, you can't just sit down and teach it. Part of my job as the CIO of QED is to try to accelerate 16 years of my learning to 3 to 4 years for a lot of the people who are newer, on the team. And I think that's even hard because until you've been sitting in a board of a failing company and have to deal with all of the issues associated with that, or of a company that's hyper scaling and have to deal with all of the issues associated with that, like, you can talk about it. But until you actually experience it, you're never going to be able to give advice, to founders who are going through it.
Can I build on this and bridge to another really thoughtful, interesting tweet that you put out about the mistakes that have been made in venture? And not saying that it's based on bad training necessarily, but just when you were observing the mistakes that were made, how much of it was people not necessarily understanding the craft of venture in some aspects, or was it more of a market dynamic? And maybe if you play that forward, what does that tell you? Because I'm sure everybody wants to know what your crystal ball is saying, because you've got a good one.
So I was very public in writing about my frustration, at the time when everything was just going nuts. Like, peak madness to me was disorienting. I mean, our portfolio is getting marked up left and right. Every 6 months, companies that had raised were raising new capital. Like, nothing had really changed. Valuations were going up by 3x. Like, I didn't have time to do my job.
Yeah.
I'd get introduced to a company and term sheets were being issued 4 days later. And like, that's not a way to get to know a company or be able to build conviction and give advice. The terms associated with the term sheets made no sense at all. If you think about the value of a company is a combination of the intrinsic value of what's been built plus the option value of what could be built in the future. The option value being ascribed to these businesses that had barely done anything were extraordinary. Like, the only way to make the math work is if you believed in a very high success rate of companies that ultimately would be public prints, and not just single digit billion public print, but like decacorn public print. And the data didn't bear that out. And it was just a unique period of time. And part of the problem was the public markets were insane as well. So, the problem is if you're building a business over 7 to 10 years, and you're drawing an analog to a public market that wasn't going to stay that way for 7 to 10 years and was eventually going to revert to the mean, like, that's where you start making mistakes. A lot of the mistakes were VCs assuming that everything they were funding were in unlimited TAM markets, right? In other words, anything they funded could be a public print. And it just wasn't true. A lot of the problem statements that were being put out into the market at peak madness, they were manufactured problems. They weren't real problems. The solution statements that were being put out, by the founder saying, this is what I'm going to build and this is how I'm going to capture economic rent, they weren't better enough than the incumbent solutions that you could build a big company around it, right? But you had talented founders and they were charismatic and capital was flowing and you knew you could get markups. So people were playing the game that was on the field. And to me, it felt very disorienting, where I think we held out longer than most firms for kind of giving into peak madness. We gave in the end. So I'm, mea culpa, like, at the end of the day, we ended up funding a number of companies at valuations that made no sense. So there were a lot of mistakes made. And I think a lot of it came down to people looking at the public markets and saying, let's just speed run building a really big business and get it into the markets as quickly as possible. And then the market said, we're done.
My last question is maybe a more personal question. It's just, you're 16 years into QED. What drives you personally today? And maybe how is that similar or different than what drove you at the very beginning?
I am annoyingly persistent, to everyone who knows me. I'm actually pretty easy to understand. So I am a reductionist at the end of the day. I like doing very few things, but doing them at as high a level as I can. Hopefully it's world-class, but I do very few things and I just focus on those things and I dive in very deep. I'm a first principles thinker and I like solving problems. So when I'm in a space and I'm trying to learn everything about it, and, at the end of the day, I'm trying to decide whether I am like the world-class person in this space and something that I want to throw myself into. If I come to the conclusion the answer is yes, I become very obsessive. It's not about the money. It's not about, any type of accolades or fame. Like, I'm actually an introvert and spend a lot of time alone. Like, I'm not all about the people. I give people 1 star, like, do not recommend. Like, I tend to stay to myself. But when talking about like interesting problems with talented founders, my brain just engages and that's where I get my dopamine from. Right. So thinking about how you solve challenging problems where I think I might be additive to the equation. Where there's a founder who I can build a personal relationship with, because again, like I typically don't like people. So when I find people who I do like, like it's a wonderful thing in the world. And the founders that I've invested in or we've invested in at QED, by and large, like I really like them. These are talented people doing really challenging things. But I think it's the intellectual challenge. That's what drives me, and that's where my dopamine comes from. I get asked all the time this question, and at Peak Madness, like it was the question to ask. If you invested in a company where your thesis was completely wrong, but you ended up with a really good public outcome, and then the company collapsed afterwards, but you ended up getting out and made a lot of money for your LPs, was that a good investment? And I say, absolutely not. Like repeatability is what matters. Like giving good advice, watching that advice actually play out and be right. Like that's what actually matters. And I know LPs, like they care about the DPI, but the way you get repeatable DPI is by being right, not by being wrong and lucky. So the only thing that motivates me is like trying to find something that I can dig into where the one skill I have in life is being a first principles thinker and breaking things down and putting it back together in a different form, or answering questions that, other people might struggle to figure out how to answer. So I think fundamentally I'm a builder and a problem solver, and the venture world gives me the opportunity to just do that with a lot of talented founders, where they put up with my incessant asking of questions and focusing on, being disciplined and getting to answers.
So building on this, given everything you've shared, people that want to know for the next 3 to 5 years, what are the areas that are most exciting for you that you might be investing in or looking at in? Because to your point about being obsessive and wanting to do a few things really well, and also having people commit to you on their first phone call, I'm trying to bring that all together into what should people bring to you and what are you looking at?
Well, I mean, at QED, we are a global fintech firm. About half our investments are in the US, half internationally. We cover many of the big geographies. So, the US, the UK, continental Europe, Latin America, Southeast Asia, India, and a little bit in Africa. So like we have a lot of the major geographies. So if it is a fintech or fintech adjacent business, it's for us. Most of the checks that we end up writing are early stage checks. Our anchor is probably Series A, but we'll do some Series Seed and we'll do some Series B. And then we have a growth fund where we might have missed a company on the way up, and it's an intriguing company, and we have the growth capital for it. But the majority of our growth fund is still funding our own companies, right? So 70% of the money in our growth fund is hunting our own logos, right? And just being the capital there with slightly different LPs, are in the growth fund than in our early stage fund. So it has a different return profile, different duration. But we have the ability to follow on our best companies. But we can pick up new logos that are more mature, and we do that every once in a while.
Well, I know we're at time, which is sad for me because I would love excuses to talk to you for longer.
You're one of the 5-star people. So, I mean.
Oh, thank
you. Agreed. I'll be the 1-star. Beezer's the 5-star.
Well, for everyone who is any other star in between, thank you also for sharing on this and for sharing so much on Twitter or X, whatever we're supposed to call it. You really put out the most thoughtful analytics on what goes on in venture. And it's really very generous of you. I know it's not simple to do all that. So thank you for this. And thank you for joining us today.
Well, appreciate the kind words.
Thanks so much, Frank.